My name is Shane Handy. I am the founder of The Rational Trader. This is a 5-part video series on trading the markets using visual order flow. Visual order flow is a way to graphically display the order flow data so that we spend less of our time picking apart the data and more time applying it to what the market is doing. Our agenda is the first video, part 1, is Introduction to Wave Volume. This is a technique we use to help us choose direction. Part 2 is an introduction to order flow. This is basic concepts and a way to graphically display it so that it is easier to see what is happening. Part 3, there's a lot of ways to enter the market. We're going to look at one in particular, which is understanding breakouts. So when the market moves to a level, looking at the order flow to help us make a decision on whether we think that breakout's going to succeed or not. Part 4 is an advanced order flow view, looking at the data in a little bit different way and then displaying it differently to help us understand where is the momentum in the market. And then part 5 is bringing it all together, how I read the market using visual order flow. Now, before we get started, we need to talk about risk. So trading is risky, and you can lose all of your money. And with futures, because of the leverage, you can actually lose more than your initial investment. There's some other elements listed on screen here that are important, and I'm going to come back to them in a moment. But first, I want to talk about the nature of risk or the source of that risk. And I think this is something that people misunderstand, and as a result are focusing in the wrong area as they work to manage their risk. The first component of risk, the first source of risk, is the market itself. I call this the technical risk. The market, we are trying to predict the future. That is inherently risky, and as a result, we need to deal with that. This is what most people think about when they talk about the risk in the market. Dealing with the unpredictability, the probabilistic nature of trading. The problem is this is not the only source of risk, and in fact, I don't even think it's the most important component. More important is the physiological risk, or the biological component of risk. And what I'm referring to here is that when you put money at risk, your body responds to that threat in the same way it responds to every other threat. It initiates a physiological response that causes fear, anxiety, doubt, and the flip side of these, excitement, greed, and euphoria when things are going your way. This physiological response impacts your ability to make sound decisions and has to be dealt with. All right. The Rational Trader was designed to recognize that this is the largest component of risk that you need to deal with, and creates a program that is intended to help you overcome it. That's what the Rational Trader does. Now, let's go back and look at suitability, performance, and hypothetical results. Suitability is talking about do not trade with money you can't afford to lose, because you are likely to lose it until you learn how to trade. Okay? You need to start small. The other component here is that you may discover that you don't have, because of that physiological response, your trading is not for you. And if that's the case, the sooner you know that, the better. The next is performance. Two people can use the same method, the same technical method, and have vastly different results. And the reason is their physiological responses and how they deal with them as they trade. This is why person A can be successful and person B will fail, even though they're using the same thing. Okay. Hypothetical results are simulations. These do not have any element of the physiological risk at all, and are therefore useless. Just ignore them. Okay. With this in mind now, let's get started. This is part 1 of our video series on trading the markets using visual order flow, Introduction to Wave Volume. This is the chart that we're going to end up with. We're going to build the components of this chart up piece by piece. We're going to start with the wave volume. So let's get oriented on this chart. This just has the bars on it at the moment. This is the NASDAQ. It is a 10-tick range bar chart. Here are the chart settings if you'd like to set it up as well. This is August 8th, 2017. On the left here is a vertical line that represents when the stock market opens. This is 6:30 Pacific. And then 7 o'clock here is news. I just have the software draw these lines. The platform here is Sierra chart. The orange line is the opening price, and this white line here is the overnight low, Globex low. 10-tick range bar. If you don't know what a range bar is, go look that up. It's out of scope for today's discussion. What I want you to notice is that the market moves in waves. All right, so you can see very clearly here. It falls. Whoops, that's the wrong button. It goes down and then up and then down and up. You can see the ebb and flow of the market here. In fact, in this particular case, you can see you fell hard. There was attempts to continue in that direction. They failed, and ultimately we advanced higher. So what we want to do is examine these waves. There is a built-in study in Sierra chart called Zigzag, which we can turn on that will draw this wave for us automatically. All right, so let's do that real quick. Here it is. And as the market trades, these lines will update and draw in real time. This is a rather complex study. If you're interested, the study settings are here. And the point here is that this helps you to see. Sometimes when the market is quite noisy, it's difficult to tell. Well, when is the wave completed and when is it continued? When is it continuing? Now, by itself, this is not incredibly useful. It's nice to see the levels that get set. It makes it very easy, and we're going to use this when we talk about breakouts. You can see, you can very clearly see the levels, and in fact, you can use that as a rule to help you only look at breakouts when you get to a level that is defined by a wave completion. That's a good way to help you keep your excitement in check. All right. However, by itself, this is not enough. What we need to know is how many people are participating in each of these waves, and that's the volume. All right. And what we want to understand is how much volume is in each wave, and how does that compare to previous waves. All right. And to do that, we have a built-in study that Sierra chart has called Zigzag Cumulative Volume. So let's go turn that on. And this is where things start to get interesting. This is going to give us a subgraph along the bottom where each of these waves corresponds to the zigzag displayed in the main graph, and it shows us the volume, the total volume of that wave. So it's cumulative in that it takes if we're looking at, say, this wave right here, as the market trades, each bar's volume is added to the previous one, and so it accumulates on the way up. And what we can see is the total volume for this wave here is the final bar here. Now, a couple of observations. This down wave here has more volume than the previous up wave. That's something to notice. You have this up wave here, not very much volume. Okay, and then another down wave where you get more volume than the previous up wave, but less than the previous down wave. These kinds of things are important, and you'll see in just a moment specifically how I'm using that. Let me show you very quickly the settings. The important thing about the zigzag and the zigzag cumulative volume is that the settings are the same, so that they line up correctly. They will not automatically set themselves up the same. So here is a quick view of the settings for the zigzag cumulative volume. Now, what we want to do is we want to examine the volume in each of these waves and use that to help us understand is the strength in that direction waning, or is it increasing? Okay, and specifically I'm using wave volume here to help me find the places where interest is declining in a direction. So if you'll notice here, what I see just looking at these waves down here is that there's a very clear decline in interest by the sellers. So this was pretty strong. I see a lot of volume. All right, and then the pullback here, the attempt to turn is somewhat pathetic. All right, it's actually it was fairly volatile. That's a pretty quick move. But then there's nothing more. And this point right here is the seller's opportunity to take the market lower. And they try to do that, but they fail. Okay, and we can tell that they fail very clearly. You nick to this level, and then you bounced, and you didn't continue lower. Okay, this is a problem because you should be absolutely taking out the low with authority if you're gonna continue lower. We bounce again, and you will notice that there is more volume in this bounce here. Okay, but more importantly is what happens next. All right, you can see this down wave, very little down volume here. All right, and so it's the relationship between these three waves that are what is absolutely key here. All right, so I actually look at them for the particular signal I'm about to describe to you. I look at the current wave and the previous two, and what I want to see is the wave volume declining in the direction we've been going. All right, and then here is the volume in the previous wave high, greater or not. In other words, I'm seeing an increase in the up volume here relative to the down volume. This signal is called no interest. We've run out of interest by the sellers. The market comes lower. There's actually another signal here we'll talk about in a moment where we nick that low. We bounce up, and then we go lower again, but we don't. There's just no sellers here anymore. All right, that bar is a signal bar. All right, or rather, that's a signal wave. All right, and that's an indication to us that the market is done going down. So what I did is I wrote a custom study here to identify that for me automatically, that particular pattern of waves. And that's what this triangle is showing me. No interest long. Okay, there's no more interest in the short side, and the direction I'm now looking is long because of this signal. All right, this signal does not draw when the bar draws. The wave has to complete. And for the wave to complete, you have to move up enough. And in this particular case, it has to move up 20 ticks, the way that I have these settings defined on this 10-tick range bar chart for the NASDAQ. So basically, when that bar finishes drawing, that signal comes on, and now I may have been looking short. I'm now clearly looking long. The way I trade, I've got very rigorous sets of rules to help me stay grounded. And when I see no interest long, I stop looking short, and now I'm starting to look for a long entry. Okay, that's no interest long. You can also see there's another one here, which we'll examine in just a moment. And no interest long. Here's no interest short. Okay, and what you're seeing here is it's the same thing. You see well, let's see. I actually think the divergence signal here is a little bit more important. So let's talk about that in a moment. You need to be a little bit careful in general when you cross an open boundary. So this is why this line is here, and it's so important. This is when the market opens, because the volume changes somewhat dramatically. All right. Prior to the open, there's much less people participating. After the open, there's a lot more. I tend to be really careful with these first sets of signals because of that. All right. What I find more interesting in this particular instance is the divergence signal. So I'm going to come back to this and talk about it in just a moment. Let's look at this no interest long signal here, and then we'll talk about divergence, which is another wave volume signal. So what we see very clearly is we've had a really strong up move. All right, there's a lot in general when we see this. Either the market is about to completely top out and reverse, or this is your new direction. All right, and instead what we see is not a lot of sellers in the next wave. We see respectable up wave. This one here is somewhat of an outlier just because it's so strong. The up wave here has more volume than this down wave. The next down wave has less volume than the first one here. All right, let me put a color there. The reason that I want to highlight this with a different color is that these waves are actually very similar. So visually, it's much more difficult to see. Here, very clearly, I can see declining interest. Here, it's not so easy. And what we see is because we have more volume in this up wave and less volume here, that's no interest long. Okay, the market actually breaks out nicely here, and we get another one of these really strong waves. All right, so when we had this strong move, whether I was participating in it or not, I'm always cautious about, okay, now we've had a strong move, or we often will reverse at this point, or you'll at least get a decent pullback. So let's wait and see what I get. It initially looks like we're going to top out, but then very, very quickly we get no interest long, and that changes me to continue to focus long. Okay, so no interest, a declining interest in one direction, with more interest in the opposite, and that's how I use wave volume to help me identify turns, and I use this specifically to choose the direction that I want to trade in. Now, let's look at the divergence signal, which is that orange bar you see. So let's focus on this one, since I tend to be careful about these ones right off the open. What we see here is that we set a low. The market set a low right here, okay, on respectable volume, okay. We then bounced and we came back again. Again, this is the seller's opportunity to take the market lower. All the people that got short should be piling in here. New shorts should be jumping in, and we should just break that low and move down hard. Instead, we don't. This wave completes on less volume than the previous wave. Less volume. We're setting a new low on declining volume. That is divergent. That is the definition of divergence. You should have more volume when you're breaking highs and lows. Instead, we don't. So this is an indication that the market is done going down. All right, this is when I see this, I have been looking short. I now am no longer looking short. I'm looking long. If a short trade is setting up, I stop and reevaluate it to see if I still think that's the case. The simplest thing to do is only go in the direction of the wave volume signal. If I'm not sure what to do, that's what I do. Whatever the wave volume is telling me is the direction I'm going to choose. So here, I'm looking long now. All right, and now I'm going to wait for, I've got very specific entry methods for divergence signals. It's actually that bar is the signal bar, or the entry bar. In this particular case, we get a no interest long signal, and that seals it. I'm no longer looking short at all. I may have been suspicious of this particular divergence long for some reason. This means I'm absolutely not, and now I'm going to look long. And the same thing up here. This is very interesting the way this works out. You get a really strong move. We often see spike moves as the tops or the bottoms. So I'm suspicious about this. And in fact, I want to see a decent pullback to get long. Here, we break the high. We set a new high right here, and we break that high on dramatically less volume. Dramatically less volume, not just a little bit less. There's a huge difference there. So I'm very suspicious now that the market is done going up. All right, so this is the seller's opportunity, right? There were a lot of sellers up here laying in wait and not enough buyers to overcome them, and as a result, we were not able to go higher. So we pull back down, and I'm now at this point I'm now looking short. Okay, is there a short trade set up here for me? Instead, we get no interest long, and this changes it. So when this bar here finishes drawing, I get a no interest long signal. I start looking to the long side. Okay, so these are two signals that I use in wave volume that really help me to understand which direction I want to go. There's a third one called failure to push. It's not displayed here on the screen, and we're out of time for today. So let's review. No interest. We're looking for declining interest in one direction with more interest in the other. All right, so this one here that's finding the bottom, You can very clearly see the interest declining, and specifically we're looking at these waves here. At the same time, we see more up volume than the this last down volume wave. So this here is my indication that okay, we are seeing more buyers now. Okay. Divergence, you're setting a new high or a new low on less volume than the previous wave. So the example displayed on screen here, we have this level set with this down wave and this volume. Then we break that low in this wave on less volume. That should not be the case. You can very clearly see that. We should not be breaking lows on less volume. It should be more volume, and that's why it's divergent. So this changes my opinion on direction, and I start looking long here. Okay, this is the end of part 1 of the video series on trading the market using visual order flow. Part 2 is an introduction to order flow.